Muted.
Good afternoon, everyone. My name is, like Katie said, my name is Brian LaCroix. I'm a partner with Jameson and Company. I've been with the firm for the last 15 years or so. Just a little bit about the firm. The firm started in 1978, where our firm specializes in government contract and grant accounting. About 10 years ago, we decided to really focus on the government contracting and grant community. And at this point, about 99.9% of our client base deal with the federal government in one way or another. We staff our firm with a lot of account managers and CPAs. We have over 10 years plus experience. And at this point, we are all across the country doing business in about 27 states with all types of agencies and all types of awards. So before we get started, a couple of ground rules and how we're going to work today. We will work through all of the slides and we'll do our presentation for the first part of the webinar. After that, we will go through the questions that were sent in prior to the webinar, and then we'll open up the floor to any additional questions that you folks may have. So, to get started, so today's agenda, we're going to be talking about DFAS and DCAA audit trends, how the government is auditing grants and contracts, what types of areas to be focused on. And part of the agenda is we'll first talk about the different types of CPAs and professionals out there, what you should look for to get help in this area. We'll take a look at what kind of awards get audited, the different types of awards that different types of audits that they use to audit these awards. Then we'll talk a little bit about typical audit tests performed, and then rules that you should follow and make part of your repertoire. And then we'll take a look and see what kind of trends are out there for the Department of Defense, NIH, Department of Energy, and then some NSF. And then we'll talk a little bit about how we typically help our clients, and we'll make sure that all the questions get answered. So to start, let's talk about the different types of accountants out there and what you need to be able to stay in compliance with the government contracting. So the first type of CPAs out there, they are typically the tax CPAs. They specialize in the Internal Revenue Code. We like to say that those folks speak Spanish. Not that they're irrelevant, they are definitely relevant. They help you to minimize your tax liability at the end of every year. But in terms of government contracting, what those folks do is typically separate from the government contracting rules. The next type of CPA out there, they typically, we like to say that they know French. Those folks specialize in GAAP accounting, generally accepted accounting principles. We look at those folks as being very relevant. The backbone of the accounting rules that you folks have to learn and follow basically relies on generally accepted accounting principles. We like to say that those CPAs speak French. And then we have the folks that understand the government contracting rules. We like to say that those accountants speak Greek, because not only do they know the generally accepted accounting principles, but they also understand the federal acquisition regulations, the cost accounting standards, and also the individual rules that come with your grants and contracts. So why are we here? Why does the government care and audit different types of grants and contracts, and what you should be concerned about? So if your grant and contract has FAR Clause 52-216-7 in it, or if it says that you are subject to FAR Part 31, you are required to maintain an acceptable accounting system, and you are also subject to the federal acquisition regulations. And that also means that your grant and contract is subject to the different types of audits that are out there. So, when do you need a Greek CPA or someone who speaks the federal acquisition regulations? If you have a cost type award that has that 52-216-7 or the FAR Part 31, you have a cost reimbursement contracted grant. The different types of grants and contracts that we see that are cost type typically are SBIR and STTR Phase 2 grants and contracts, the ARPA awards from the Department of Energy, any R01 awards from the National Institutes of Health, BAA awards, are many times cost reimbursement, barter type awards, and other various awards will have, Army Medical Research Office awards will also be cost reimbursement and subject to the cost reimbursement standards. So, now that you know that you have a cost reimbursement type award, what rules should you be worried about? First of all, the first layer of rules that you have to understand and know are the Federal Acquisition Regulations and the cost accounting standards. These are the backbone for all of the accounting rules that you are subject to with a cost reimbursement type award. The second type of rules that you should also know is on top of the FARs and on top of the cost accounting standards, the NIH and DOD and DOE all have their own specific rules that they will put on top of the Federal Acquisition Regulations. They have their own twists and turns on those rules. For instance, the National Institutes of Health, they do not believe that they have to fund internal research and development costs, where the Federal Acquisition Regulations say that IR&D is an allowable cost and can be put in the numerator when calculating your indirect rates. The NIH takes the stance that you should fund your own research and development, in which case you have to put it in the denominator when you calculate your indirect rates. There are also different rules as far as patent costs. The Department of Defense, depending on if you meet certain criteria, those costs will be allowable. If you deal with NIH, they will not pay for them. NSF has different rules as far as the allowability of direct and indirect costs as well. The next layer of rules are program-specific rules. ARPA-E and SBIR, for instance, both have certain rules that you have to comply with. For instance, SBIR rules say that your PI must be at least 51% employee of the company. There are also ownership rules that you have to take into account. And finally, you have contract and grant-specific rules. If a contracting officer or grants management specialist are concerned about different parts of the proposal, or they want you to spend research and development dollars a certain way, they'll put restrictions into the grant and contract to account for those concerns. For instance, we'll see a lot of times if a grants management specialist or a contracting officer is nervous about a company's indirect rates, they will put caps on the rates themselves. So now that we've determined that you're going to be audited, we like to give a little survival guide on what you should and shouldn't do with auditors. One thing that we typically see is a lot of people will give an auditor too much information. You should always look at an audit as far as the auditor will take every word that you say, and not only will they elaborate on questions, but they will also adjust their testing based on the responses. The goal of the audit is to get through as quickly as you can and to make sure that you give all the information to the auditor that they're looking for and let them do their job. So we typically like, when we deal with audits, we like to speak when we're spoken to. We like to make sure that we always understand the question that's being asked and what the underlying piece of that question is, what the auditor is getting at. We try to use as few words as possible because what the auditor does is they will take those words and, like I said, would expand their testing depending on the responses. So, now that we know that we have a cost reimbursement type contract, here's the process and the routine that typically happens when you're a government contractor and grantee. It all starts with the cost proposal. You submit a cost proposal and a technical proposal. You submit it to the government. The government negotiates that price with you. And during that negotiation, oftentimes they'll do what's called a pre-award review, where they will come out and they will look at your accounting system, make sure that it's acceptable for a cost reimbursement type contract. Once the award is given, on an annual basis, depending on which agency you're dealing with, you have to submit what's called an incurred cost submission. That incurred cost submission reports to the government what all of the company's costs are from the indirect side and also the direct side on each cost reimbursement type contract, plus also each commercial and fixed price contract. At that point, the government determines whether they will audit that submission, and that audit of the submission may come anywhere from like a year after to 3 years after, depending on the agency you're dealing with. Toward the end of the year, after the incurred cost submission is submitted, which is due 6 months after after your year end, you have to submit what's called an annual rate projection to the government. That rate projection sets your company's indirect billing rates for the following year. And then the cycle starts again with the incurred cost submission, audit and submission, and rate projection. So one of the things that we tend to always focus on anytime we submit one of those incurred cost submissions, each auditor and audit that we've dealt with always does what we call a flux analysis. The flux analysis takes the prior year expenses and compares them to the current year expenses. So one of the common work papers that we have our staff prepare is what the reasons are for the different expense categories going up and down. And we have our clients submit their answers to us, and we document why the different expense categories increase or decrease. The reason why we do that is eventually when the audit happens, and like I said, it can also happen 3 years down the road, is you will eventually have to answer those types of questions from your government auditor. So we like to prepare in advance to make sure that we do have the answers before they ask the questions. So now let's start to talk about what type of audits are out there. And what we're going to start with is the Department of Defense. So when you are about to receive a cost reimbursement type award, DCAA will typically contact you to do what's called an accounting system review. What DCAA is looking for is that you have an acceptable accounting system in order to account for all of the direct and indirect costs for cost type contracts. They will come in and they'll audit the individual elements of your accounting system to make sure that it's in compliance with how they expect expenses to be accounted for. After they do that pre-award accounting system review, a lot of times if you already have cost reimbursement type contracts, they'll test the accounting system to make sure that how you've documented the accounting system actually works the way that you've documented it. If you don't have any cost type work at that point, what they may do is they may say that we're going to come back for a post-award review. And during that post-award review, it'll happen a couple of months after the contract is active. They'll come in and they'll audit some of the cost on one of your invoices to make sure that the accounting system's functioning appropriately. Another type of audit that the Department of Defense and DCAA does is surprise floor checks. We've been told from some of the auditors around the country that these types of audits are coming back into play. We haven't seen them the last couple of years, but we've been told by a couple of DCAA auditors that they've been told from their management they have to get back out and start doing these types of audits. Now what they are, we'll get to what they are in a slide or two, but basically DCAA reserves the right to show up at any time, knock on your door and start to interview your employees about what they're working on and looking at your timesheets to make sure they're up to date. Provisional indirect submissions, like I said in the previous slide, once a year you are required to submit your provisional billing rate proposal to DCAA. They review that billing rate proposal and they will audit different elements of it if you're asking for larger increases in the indirect rates. Then what they also do is voucher government billing audits. Now these voucher audits are happening in two ways. One, they're doing they're doing these voucher reviews on site, and we have a slide for that, a couple of slides from now, and they're also doing them randomly. So we have one contractor down in Texas, it seems like they have 3 invoices reviewed every month, and we'll talk about the different reasons why these things get picked for audits. And of course they do the incurred cost audits, which of that rate submission that we spoke about a couple of slides ago. So DCAA is the government's audit agency. Right now, DCAA has about 4,500 auditors across the country. They have about 300 branches. Their function is to be hired by the individual customer, meaning the Department of Defense. They also work for the Department of Energy. And they come out and they audit costs to make sure that you are billing appropriately on all your contracts. So what does a DCAA audit look like? The surprise floor checks, they always happen at your facility. Again, that's a timesheet type of audit. The annual incurred cost audits, they will come out wherever the accounting records are located. They want access to your vendor invoices, your timesheets, your general ledger information. Your accounting system audits also happen wherever the accounting records are located. They want to see the accounting system in action. And then the voucher audits can happen either through a desk audit or also the new audits that voucher audits that they're performing, which are on site. So what does a surprise floor check look like? So when the auditors show up to do a surprise floor check, they will ask to interview several of your employees, and what they're asking for is they're making sure that your timekeeping system is acceptable. So what they look for is if you're doing manual timesheets, that the timesheets are filled out daily in ink, that they are signed by the employees, that they're signed by the supervisor, and that if any changes are occurring on the timesheet, that they're crossed out, initialed by the employee, and then detailing why the changes are occurring. Now, of course, this day and age, most people are keeping automated timekeeping systems. Those timekeeping systems have to still do the same type of elements. Whether you have password protected sign-offs by the employees and the supervisors, any changes have to have an audit trail as to why those are occurring as well. And of course, at the end of the day, they have to be filled out based on the most current project that the employee is working on. So these audits are typically performed in conjunction with a post-award accounting system, although, like I said, we've been told that recently they're going to start doing random ones as well. So if you take anything from this webinar, one of the most important things that I talk about whenever we speak is that of all your accounting systems, it's very important that you keep an acceptable timekeeping policy in place and that you encourage your employees to keep their time to the best of their ability. And the reason why is the government encourages whistleblowers. We always tell the story. We had a client. The client was an MIT professor. He was married. His wife was the controller of the company. And at one point, he decided that he wanted to get a divorce from his wife. And the very next day, of course, the DCAA auditors show up, and they were there for the surprise floor check. They went around and they interviewed the employees and asked what you're working on, and the employees told them, rightly so. And then, but they said, what do you charge your time to? And they were like, we charge our time to this cost reimbursement type contract, because they had funding on it, which of course is a violation. That caused the company to have their cost reimbursement type contracts shut down. And then now the MIT professor, I believe, works for one of his research students. So it's important to get these policies right. Make sure that your timekeeping policies are up to speed. So again, the DCAA annual incurred cost audit. These audits are important because it summarizes all of your year-end costs for the Department of Defense to look at. It's going to tell the government what your company's direct costs were on all of its cost reimbursement type contracts, and also what your indirect costs were for the year, and it will show what's allowable and what's unallowable. So why it's important to get the allowability correct is most contracts that we see these days come with the penalty clause, and what that penalty clause says is if you put any expressly unallowable items into that incurred cost proposal, not only can DCAA disallow it, but they can also assess 100% penalty on it. And I've seen it happen. We had this one client, well, they became a client after they got assessed a penalty. The controller at the time placed federal income taxes in the cost proposal, which are expressly unallowable. And of course, DCAA came in, and it was a large tax bill that year, about $250,000. Not only did DCAA disallow it, but they assessed a penalty, which we turned around and we basically tried to get abated right away. But DCMA, who's the arbiter of it, said, we really can't do that. That ignorance isn't an excuse for putting it in the proposal. So it was a $500,000 day for that particular client. So the way that the annual incurred costs audits work is several years ago, the independent review panel recommended more of a risk-based approach for planning for DCAA. And the reason was DCAA was quite far behind on their incurred cost audits. They were 5-6 years behind. So they needed a mechanism whether to assess these clients for high risk or low risk. So they typically look at smaller contractors. They take a look at the amount of indirect costs that a company may have, and they may put you into a low risk category. What that means is they'll review the cost proposal, and they'll accept the incurred costs as proposed, as long as they are able to put you in the low risk category. If you are fortunate enough to be selected for an incurred cost audit, they've become much more thorough through the years. Before, it used to be a half-day event. Now it can go on for several days. Depending on the size of the contractor, it can extend for months. And they look at a lot of categories very closely, and they're more thorough with the information that they're looking at. And we'll get to that in a slide or two. So how is low risk determined? It's based on if there are prior audit findings, the number of the size of the awards, and your indirect rate versus your actual rate. For instance, a lot of our R&D contractors who have outside funding, they will ask for a lower indirect rate than what they're actually running at. This, of course, reduces the risk to the government that they'd have to find a lot more unallowable costs for it to make a difference. So, progress billing audits. Like I mentioned before, that we have some contractors that do have a large number of voucher audits selected for audit. And the reason for some of those audits are you could be a newer contractor. The invoice could be a high dollar threshold, 25% of your average invoice for the last 12 months. If you submit a higher invoice, it could get selected for review. And then if you've had any issues with incurred cost submissions, progress billing audits, or surprise floor checks, they may come back and want to take a look at some vouchers to make sure that you're not overbilling them. During one of the voucher reviews, you will be required to send to DCAA all of the supporting information in the invoice, and so they can take a look at it to make sure that there's support behind all of the invoice items. Or you could just be, I've been told from some DCAA auditors that the voucher audits are just simply random, and that your number came up and they want to take a look at the invoice. So in addition to that, they look to audit more invoices, so that way they can support putting contractors in a low-risk category. If they're doing multiple audits in different areas and those audits are coming through as being okay, they have justification to put you in that low-risk category. One of the newer audits that DCAA is required to do for smaller contractors is they are required to come out and do a random audit of a progress billing. This audit is live. You will have a DCAA auditor in the office, and they've effectively termed it a mini accounting system review, where not only are they auditing the individual elements of that particular invoice that they selected for audit, but they're also looking at your accounting system to make sure that it's continuing to do what you've said that the system can do in the past. They want to make sure that the accounting system is running effectively. Also, so they can continue to put people in low-risk categories. They have justification for that. So again, that audit is performed on-site by DCAA. They do interview employees. It's not as expansive as a surprise floor check, but they will ask a couple of questions from employees. And the employees will be asked to show some of their work product as well. It's one of the things that work product is one of the items that the government's keen to these days. They like to see that not only people are charging their time, but what they're doing as well. The auditor will then trace some of the time charges from the timesheets. They'll look to go into the payroll journal, labor distribution, job cost records, and then also to make sure that it eventually hits the invoice. They always like to go bill to book, book to bill. They want to see that the accounting system works both frontwards and backwards. So some DCAA audit trends that we are typically seeing these days, the different areas that they like to look at, consulting invoices or consulting costs charged to contracts. This is both on the direct side and the indirect side. In order for a consulting cost to be allowable, it has to be supported with a consulting agreement that details the scope of the work that the consultants are working on. It also, their invoices from the consultant should detail what they've done, the amount of hours charged, and then, of course, the total dollar charge based on hours times hourly rate. If you think about a typical lawyer's invoice where it's very detailed, line by line, that details the amount of hours being spent, that's what they are looking for from for consulting backup. They'll do random billing audits for consultant type work, and also if you have employees that work from home, they will want to see work at home policy. Your work at home policies should also come with work product. They want to make sure that people who are not working on site are properly supervised and that they are actually getting paid for actual work being performed. Subcontractor costs are also a large area that they are looking at. They look at consistencies between the subcontract agreement to the subcontractor to make sure that if you tell a subcontractor that they have a cost reimbursement type contract, then they are submitting invoices to you that you can see the individual cost elements. At that point, the subcontractors, either you will be auditing that subcontractor if you're a DoD contractor, or that they will submit their incurred cost submission to DCAA for them to audit. If you have any mistakes during these audits, the incurred cost audits are always involve expanded testing. If they find 1, 2, 3 errors, they will expand their testing and stay as long as they have to receive that comfort level that you are not overbilling the government. And of course, the audits are more aggressive these days. So one of the pre-webinar questions that we got is, why does DCAA or the government audit the small guys? Well, it's because every so often one of these cases come up. I was an expert witness on this particular case with 2 professors down in Houston who started an SBIR company, and they were improprieties with their proposal and also with the charges to the government. At the end of the day, the charges were brought down to a misdemeanor, but because of how they sentence misdemeanors in Texas, that they assess the penalty based on the damages to the government. They assessed a 6-month jail sentence for people with these 2 professors from the small SBIR company. So they do find, the auditors are out there, they do find issues quite a bit. So that's why they continue to audit smaller businesses. NIH grantees. So DFAS is the NIH audit arm, and the NIH audits their grants in 2 different ways, or 3 different ways really. You have the pre-award audit, and that's really done by the grants management specialist. You do a just-in-time worksheet for the grants management specialist that basically tells a little bit about your accounting system, that you have timesheets, that you have job cost systems, and you're able to discern between direct and indirect costs. This is a self-certified form. The grants management specialist will look at your financials to make sure that you look like you're solvent. The just-in-time information from a financial level with NIH doesn't go much further than that. They do not do on-site audits for the just-in-time activity. The second layer of audit, if you're an NIH grantee, is the uniform guidance audits. And this is really true with most grants, that if you spend more than $750,000 a year in grant funding, you are subject to these uniform guidance audits. Uniform guidance audit is a compliance audit where you go out to an independent accounting firm. You say, I need a UGA audit done. They will come in and audit the individual elements of your grants, make sure that you are in compliance with all 11, 12 areas that you've signed up for, and they will also audit the expenses to make sure that you are not overcharging the grants. So they will be looking at timesheets. They will be looking at individual material invoices. They'll look at indirect rates. They'll look at reporting. Different areas of compliance to make sure that you understand what the rules are that you've signed up for with the grants. And finally, you have the audits of the incurred cost submission. If you select a greater than 40% rate with NIH, you have to submit what's called an incurred cost submission on an annual basis, and you actively negotiate your rates with the NIH. So the 40% rate is subject to only SBIR grants. So if you have an R01 grant or a barter type award or a UO1 grant, you'll be required to submit that rate submission even if you're below the 40%. Audit trends with DFAS in the NIH. They are looking at indirect consultants as well pretty closely. And the reason why they look at individual consultants is they are looking at the work that they're actually performing. If they are doing technical work, anything related to the science or research and development, they are going to look to put that money in the denominator rather than the numerator. Again, like I said at the beginning of the webinar, that NIH believes that research and development should be funded by the individual grantee. In which case they will be looking to see those costs in the denominator when calculating your indirect rates. They also look for any items related to business development or commercial activity. They will disallow them. They believe that any kind of business development, any type of raising a capital should be also funded by the individual grantee. And then they also look at you to see if you're flowing down the accounting requirements to subcontractors. With the Department of Defense, you have the choice, depending on the size of the subcontract, whether you flow down the individual cost elements to the subcontractor. With NIH, you don't have that type of choice. You have to flow down the individual requirements to the subcontractor. You should be monitoring them to make sure that they are not overcharging you. in which case you should be asking for their individual UGA audit report and reporting any types of issues to NIH. One of the hot button areas that I see NIH looking at is labor utilization reviews. One of the reports that they ask for during their incurred cost submission is a full salary roster with employee titles and also how they spent their time. One of the items that is really a hot button area is they look at a certain utilization rate for small businesses. The labor utilization rate is the ratio of direct labor to productive labor, which is indirect plus direct labor. That ratio should come in at about 65 to 70% for a small business. So what I've seen the auditors do with a couple of different types of companies is if that utilization rate falls in the 50% range and stuff, they will make an adjustment to bring it up to that 65, 70%. So in effect, they're reducing your company's indirect costs. So it's important to make sure that people are recording their time properly as to what they're doing and to at least understand the concept of what's happening with the labor utilization rate. Again, this is the type of report that you have to submit to support that labor utilization rate. So you would have to list the different types of employees, how much money was allocated direct, how much money was allocated indirect, and what their total compensation was. And they look to make sure that where the time is being charged and where the salary is being allocated matches up to what they expect the employees to be doing. So we always like to put this screen up. A lot of what we see on the SBIR level, we call it inadvertent fraud. But basically the way that the 40% indirect rate works, it's the largest rate that you can ask for without negotiating an indirect rate. We see a lot of smaller grantees select the 40% rate without understanding fully what their actual indirect rates are running at. So the way that the 40% rate works and the way that we see it work with smaller grantees is they will take the 40% rate and then they will draw down money as they need it, whether it's direct or indirect. So at the end of the year, you calculate the indirect rate, and if that indirect rate comes in at greater than 40%, you've effectively overdrawn on the grant. You are only allowed to be able to draw up to 40% indirect rate. Any kind of overages have to come out of your own company's resources. That's the drawback from selecting the 40% indirect rate. So our NIH guys really make a decision whether they are going to, most companies' indirect rates will run greater than 40. So they make a decision whether they are going to fund the overages themselves or if they'll go through and they'll actually work on getting an indirect rate negotiated with the NIH. And this is the form that we see people sign. They sign the FFR saying that they've spent all of the costs without knowing that they overran their 40% indirect rate. So they've drawn down funds more than they should have. And of course, like I said, this is why the NIH audits folks as well. They do audit smaller businesses because they do find issues where effectively grantees have overcharged the government or used funds for things other than what the funds were intended to be used for. Other trends that we're seeing, if you have ARPA-E awards, they outsource the administration of the award a lot of times to Booz Allen. And what Booz Allen's job is to audit each individual line item on every invoice. So you have to submit all of the support to each invoice. It's like going through a voucher review on every single area. And a lot of times they will be tossing out expenses for the smallest things. If the errors are larger, it also delays payment for the ARPA-E awards. NIH, we also see that some new awards are being held up these days for failing to comply with the uniform guidance audits. Some folks won't understand that they had to go out and get a uniform guidance audit. The grants management specialist will take a look in the payment management system to see that they've drawn down in excess of $750K, and then they're asking for the audit report. Of course, when it hasn't been done, it can hold up new awards from being funded. Then NSF has a pretty rigorous CAR review process, where prior to you receiving a Phase 2 award, you have to prove your solvency and liquidity to the NSF. They have a very stringent look and view of what you should look like in order to receive funding from them. A lot of folks have trouble if they do have debt on the books or convertible debt, that you have to prove to the NSF that you are going to be solvent for the 2 years that the NSF award lasts. I always talk about this one client. We were hired by a client in New York. They went through the CAR review process themselves, and they had about $10 million on the books in convertible debt. They didn't understand that they had to really explain what the $10 million was and that it was non-callable. And what happened during the CAR review process is they failed the CAR review because the NSF determined that or deemed them to be insolvent, and they would not give them the Phase 2 award. Of course, that debt was converted into equity after the fact, and they were effectively the most solvent SBIR company I've seen. But because they didn't understand the whole review process, they were basically denied their award. So how we typically work with folks and how we supplement your financial team, we're involved with a lot of folks with their indirect cost rate development. We help you develop your indirect rates, making sure you're putting into your cost proposals what it's going to take for you to run your company. We help with financial negotiations with government officials. We do accounting system setup, training, periodic oversight. We prepare annual incurred cost reports, and then we represent you when those reports get audited. We have some introductory products as well that you can find on our website. We have a Phase 1 survival kit for you smaller grantees and contractors that will help get an acceptable accounting system in place. We have indirect rate projection and proposal support, and of course risk and compliance analysis if you're worried about your accounting system. And then we have different webinars and white papers at our website. We also have an e-newsletter. You can follow us at Jameson CPA. And then we speak at the National SBIR Conference twice a year. Our next one's coming up in May. So what we're going to do now is a lot of folks submitted questions before the webinar. I'm going to go through a bunch. I'll answer those. Then we'll open up the floor for questions, live questions, and we'll see if we can answer them as well. So we have a question that can we have a part-time employee, not senior personnel, that has a full-time job somewhere else? Yes, you can have part-time employees. There are SBIR rules as far as if that person is the PI on a grant or contract, that you have to be at least a 51% employee of the company. When will the financials for Phase 2 be requested? Well, if you're an NIH grantee, that they will request those during the just-in-time process, which is the pre-award process before a grant is awarded. Does firm size impact whether you will be audited, or is it all firms that work under the SBIR funding? It does not. Basically, you are subject to audit no matter what size your company is. If you're an NIH grantee, you're absolutely subject to the UGA audits depending, no matter what size you are. If you're a DoD contractor, like we said in previous screens, that you can be put into the low risk category, but it's always subject to the different types of audits. This is from a National Institute of Health grantee. Liabilities and exposures to subcontractor subawardee risk, especially with PIs on subawardee status. So if you are a subcontractor to a prime grantee, you are subject to the same accounting rules that the prime is. If you spend more than $750,000 as a subcontractor, you have to go out and get a UGA audit as well. So you are subject to the same rules as if you were a prime. How do we help classify profit here? What is acceptable? The profit on grants and contracts, if you're an SBIR grantee or contractor, they're research and development contracts. The 7% is the typical fee profit that we see on those types of awards. And are direct and indirect costs worth quoting, or do we lump it all into direct costs? Well, there's a big difference between direct and indirect costs. Direct costs are costs that are specific to a contract or grant. Indirect costs benefit all of the company. The government will be looking to make sure that you can discern between one or the other. Allowability of patent costs related to an SBIR award in surviving a DCAA audit. As far as patent costs go, for a DoD contractor, they can be allowable, but there have to be certain FAR clauses in your contract, and you have to make appropriate disclosures to the government as far as what has been invented. And there's a few hoops that you have to jump through. If you are able to jump through all of those hoops, you can get them claimed in your indirect rates. How exempt employees should keep time. Example, an exempt scientist works 80 hours, 5 indirect hours, and takes 8 hours of vacation during the 80-hour period. Does the exempt employee need to log indirect time if they have logged 80 hours of direct time? The employee has to log all of the hours that they work, whether it's direct, indirect, or vacation, sick, and holiday time. The reason is the labor has to be allocated in your general ledger based on what the employee has worked on. If you cap the amount of hours at 80, then the allocation between indirect and direct may be off because of that, and it affects your indirect rates. What expenses are allowed for the administration expense? So there is a whole list. This is from an NIH grantee. There is a whole list of indirect costs in the NIH policy and procedure manual that details what is allowable and what is unallowable. Basically, the day-to-day operations of a company are allowable, but you should definitely refer to that. Let's see. Fixed fee withholding. So under DoD contracts, many times there is a FAR clause for the fixed fee that sets aside about 15% of the fee amount until the contract is wrapped up. So what that means is you accumulate the fee, but you cannot bill that last 15%. Basically, the Department of Defense uses it as a retainer until all the audits are done to make sure that if anything goes wrong at audit, that they're holding back some money instead of having to go after you for the full amount. There was also a question on when you are able to bill that, and unfortunately, we see different answers across the country. I've worked with some ACOs at DCMA that basically says once you've fulfilled all the requirements under the contract that you can bill 100% of the fee. Then I've seen some ACOs that say you cannot do that until DCAA signs off on your last indirect rate submission under the contract. So it really varies, and it depends on who your administrative contracting officer is. let's see, issues on salary caps. When a company has VC funding where it's willing to pay key employees more than the NIH salary cap limit, how do you deal with timesheets and accounting reconciliation when an employee's salary exceeds the caps? Well, the timesheets have to, the same rules apply, that you have to have the employees record all of their hours. The resolution is how you distribute the labor. So if a person's working directly on a project that where you're only able to bill up to the salary cap, you have to set up your labor distribution that the part that's unallowable or in excess of the cap goes to an unallowable direct category. Remember that the salary cap for NIH really is focused on the direct side of the equation. The indirect side comes through as the during your rate negotiation. So that's all I have for the pre-sent questions. We're going to open it up to, there's quite a few.
We have quite a few questions.
We have quite a few questions outside.
So we'll just go line by line until we kind of run out of time, and then any questions that aren't answered, this is Katie Crowley, I will try and follow up with you after the fact.
So our FDA awarded, not NIH, it looks like they were R01 grants. Are they also subject to audit? I would say yes. They're going to fall under the UGA audit guidance. And also on top of that, typically R01 grants, you have to negotiate a rate with the NIH. You just can't claim the 40%, which is only subject to NIH, SBIR grantees. For an NIH SBIR grant, who does the audit of large subawardees? Who is liable in case of accounting issues? So ultimately, the prime grantee is responsible for the subawardees. Normally, if you're dealing with a university, though, they're going to have their own UGA audit done. They receive a ton of funding from the federal government. So your responsibility is to ask for a copy of that UGA audit. In that UGA audit, it should detail each individual grant that they are working on, and it will specify if there's any issues with the charges on that grant. So at that point, if there are issues, I would approach your sub-awardee and say, that you want to resolve the issue. And if they're not willing to work with you, then I've seen other grantees go to NIH directly to let them know what's going on.
The next one, Michael's left the room, so we'll respond to that individually.
Yep.
Any trends with NASA audit?
NASA typically falls under the Department of Defense or DCAA. They typically audit their contracts the same as all of the DoD issues that we said in previous screens. What are the rules regarding a wife being paid for performing accounting services for the husband's NSF funded company? Can she be paid from grant funds, and how would it be allocated? Well, if the wife is doing an accounting service and she's getting paid for that, it sounds like an administrative expense that's ordinary, necessary, and reasonable, and can be recaptured in the company's indirect rates, subject to NSF's indirect rate accounting rules. Some months the indirect is 40%, some months it's lower. Can you draw down more than the 40% that month? If on average, no, you can't. You're capped at 40%. At the end of the year, you are required to calculate a final indirect rate and adjust your billings accordingly. So at the end of the year, your rates are measured on a yearly basis. If the rates run under 40, you have to adjust your billings on the grant to that lower percentage. And if they run over 40, you're capped at the 40%. But just because your rates are fluctuating doesn't mean that you can draw in advance. In defining indirect rate, please confirm that the definition for this purpose only includes overhead and G&A and not fringe. Well, your fringe rate is an indirect cost. Now, I've been around with this with NIH in the past. So for some reason, they look at fringe as a direct cost on the grant. I'm like, but it's not, because the fringe costs get allocated to direct labor and indirect labor based on the calculation. So NIH has a funny view of looking at fringe, but if you are dealing with the Department of Defense, it's absolutely an indirect cost. What determines a small contractor? It's basically number of employees. It's also revenue for the year. You have to be a large contractor. You're doing, I believe the threshold is $25 million a year in revenue. How to determine if you're a subrecipient or a subcontractor? They're essentially the same. The way that I typically look at it is if you are participating in the actual research, if you're collaborating on actual research for the grant or contract, you are a subcontractor. There are certain vendors in there that aren't participating in the research, like contract research organizations, where you basically tell a contract research organization exactly what to do, what kind of experiments to run. I look at those as a vendor. But if you're doing actual research, you're a subcontractor or a subrecipient. Can you talk more about timesheet surprise floor audits? What are acceptable timeframes for completing timesheets, for getting supervisor approvals, for modifying paid time off or other errors? So typically with surprise floor audits, the timeframes for completing timesheets, usually at the end of a pay period, is perfectly fine. You know, I usually don't like it to go more than a couple of weeks, but as far as recording time, you should have what you're recorded as time up to the current task that you're working on. Supervisor approvals, again, I would make sure that those are done by the end of the pay period. And for modifying for PTO or other errors, I would say at the end of the time period, you should have that pretty well buttoned up. In the presentation, you said that IR&D is unallowable, but the example leads me to believe that it's considered indirect and not unallowable. Please confirm. So it really depends on the agency that you're dealing with. IR&D is an allowable cost for a Department of Defense contractor subject to the FAR Part 31. If you are working with NIH, however, and NSF and DOE for that matter, they believe that IR&D is that they shouldn't have to pay for it in your indirect rates, and it belongs in the denominator when calculating your indirect rate. So they believe that you should be paying for it out of your own funds, and as well that they should absorb its proportionate share of the company's indirect costs as well. When do you offer this webinar again? We do webinars pretty regularly. Katie will let you know.
Yeah, this next one, it'll be October 26th. Registration opens a month prior on our website. So, yeah, see you then.
I am working on my Phase 2A sequential phase on a DOE SBIR project. I have not yet had a DCAA audit. When should that be expected? If it's a DOE SBIR grant, typically it will not be audited by DCAA. You're subject to the UGA audits that come along with grants. The DOE SBIRs typically come through as a grant mechanism rather than a contract. DCAA typically audits contracts. With a total award of $1 million, with sub-awardees spending of $400K and the main awardee spends $600K, to neither require an audit in this case. So I assume that this is a grant. If it is a grant, it all depends on how much you spend in the current year. If you spend $750,000 in your company's fiscal year, and that $750 includes both your direct and indirect costs plus the sub-awardee costs, you are subject to the UGA audit. For NIH SBIR contracts with indirect rates less than 40%, there are annual rate adjustments that result from the uniform guidance audits. For an example, if a UGA audit shows actuals that a higher or lower than projected will adjustment be mandatory. You're required to adjust the billings under your grant to your actual rates every year. So you should calculate your indirect rates at the end of the year as part of your closeout process. And if those rates come in less than 40%, you should be adjusting the billings on your grant or contract to that lower total. If they are higher than 40, you're stuck with the 40% because you do not have a negotiated indirect rate. How and where do we register for the National SBIR Conference? That would be the Tech Connect website. We'll be there in May. We're happy to meet up with you. Our NSF SBIR company uses a payroll service, and the payroll reports show the hours worked by employees. What additional documents do you need? Well, you have to have actual timesheets that are signed by the employees that detail what they're working on, whether it's directly on the project, whether it's vacation, sick, holiday time, or indirect time. Every employee has a little bit of downtime. So the timesheet should reflect what they are actually spending their time on. And then what you are also required to do is to take the time that was spent and spread out the salaries based on the time. For instance, if you have an employee that makes $1,000 for a payroll period, and 50% of their time on their timesheet was charged to the NSF grant and 50% to vacation, sick, and holiday time, I would expect $500 in labor to be charged to the direct labor category and $500 to vacation, sick, and holiday time.
I will take one more question, and then the rest of the questions I can send out the answers to via email.
Does the difference between a subcontractor and a subrecipient affect a requirement to do a single audit DOE grant subcontracts? There are certain rules as far as if you're a subrecipient on a DOE grant, there are rules related to the total dollar amount of the subrecipient or the subcontractors and whether you need to do an audit. You should refer to the DOE audit guidance, or you can reach out to me and we can determine whether you need an audit or not. But the general rule is subrecipients and prime grantees on DOE grants are subject to the same audit requirements as the prime.
Okay, well, thank you everybody for attending today. Our next webinar will be in a month or two from now, but you'll get an email blast inviting you to the next one, which I believe will be specifically on indirect rates. So if you have any questions, feel free to email me. It's Katie, Katie, @Jamieson CPA. Thank you.
Thank you.